Jornad Trust here. In this video, I'm going to break down 4 ways to turn home equity into monthly cash flow for you and what to consider when getting into commercial real estate. However, before I start, hit that subscribe button and like button. I appreciate you. So you can convert your home equity into monthly cash flow through several established financial strategies. Now, here are the primary methods along with how they work and what to consider. You have number 1, home equity line of credit, also known as a HELOC, and its cousin, HELOAN. I'm going to discuss a little further, but let's stay on HELOC. Here's a general way to apply for a HELOC, which is basically a home equity line of credit. You have to assess eligibility and choose a lender. Ensure you have sufficient equity in your home, typically at least 15 to 20%, and a good credit score, often 700 plus is ideal, but some lenders may accept lower. So don't get in a frenzy here. Check that your debt to income ratio and payment history are in good standing. Research and compare lenders for rates, terms, and fees. You can apply online, by phone, or in person at most major banks and credit unions. You're gonna want to, gather required documentation. That is like, proof of income, pay stubs, W-2s, tax returns, bank statements, etc. Also, items like the mortgage statement and property tax bill, identification, whether it's driver's license, social security number, information about your property like the original purchase price, purchase date, the current value, details on any existing liens or mortgages. Basically you want to complete the application. So fill out the HELOC application online, by phone, or in person, providing all requested information about your finances and property. Some lenders may require you to have an account with them or may ask for additional documentation. The lender will review your application, check your credit, and verify your income, and often order a professional appraisal to determine your home's current value. So this step determines your maximum loan to value ratio and the credit limit for your HELOC. So once approved, you'll receive the terms of your HELOC, including your credit limit, interest rate, and repayment terms. Review and sign the loan documents. You may need to pay closing costs at this stage, though some lenders allow these to be rolled into the loan. Depending on your state or lender, closing can be done in person, online, or as a hybrid process. Access your funds after closing. You'll receive access to your HELOC funds, often via checks, a card, or online transfers. You can draw funds as needed up to your approved limit during the draw period. The typical timeline, the process overall, it takes about 30 to 40 days, though it can vary based on the lender requirements and whether an appraisal or additional documentation is needed. Here are some quick tips for this, Compare multiple lenders for the best rates and terms. Have a clear plan for how you'll use the funds and basically repay the line of credit. Maintain good financial records to streamline the process. Here are some noteworthy HELOC lenders. According to some research, Truist is widely recognized for its flexibility, high credit limits, and fixed rate options, making it a top pick for many borrowers. Next is Flagstar Bank, which is a strong choice for borrowers seeking high loan amounts and broad state availability with competitive rates and discounts for auto pay. Bank of America is next. That stands out for its nationwide accessibility, no fees, and multiple rate discount opportunities, especially for existing customers. Navy Federal Credit Union is next after that, which offers excellent customer satisfaction and no fees, but is limited to military families. Now, that is the first strategy. Let's get into the second strategy, which is a cash out refinance. And that's basically where you replace your existing mortgage with a new larger loan using the difference between the new loan amount and your current mortgage balance as cash in hand. This approach allows you to tap into your home equity to access funds for various purposes, such as debt consolidation, home improvements, or investments. So here's how it works. You apply for a new mortgage, typically up to 80% of your home's appraised value. The new loan pays off your existing mortgage. You receive the remaining balance as a lump sum of cash. The new mortgage will have its own terms, interest rate, and monthly payment structure. Now, here's the impact on the monthly cash flow. There's the increased mortgage payment. Because you are borrowing more, your monthly mortgage payment will generally increase. As an example, if your original mortgage was $100K and you refinance for $140K, Taking out 40K cash out, your new payment is based on the larger 140K balance. So if you use the cash to pay off higher interest debt like credit cards or personal loans or that home equity, your overall monthly debt payments may decrease, improving your net monthly cash flow. If you use the cash for investments that generate income, such as buying rental property, you could potentially increase your monthly cash flow depending on the returns from the investment. If you use the funds for non-income generating expenses like vacations or cars, your monthly cash flow will decrease due to the higher mortgage payment. Here are some key considerations in this regard. There's the loan to value. Most lenders allow you to borrow up to 80% of your home's appraised value. You need to have good credit, a low debt to income ratio, and sufficient home equity. The interest rates, if rates have dropped since your original mortgage, you might secure a lower rate, partially offsetting the higher payment. There are closing costs, so all related costs can be rolled into the new loan, but this increases the total amount borrowed and your monthly payment. Here are pros and cons of this strategy. The pros are you have access to large sums or cash for investments or debt consolidation. There's potential to improve overall finances if used to pay off high interest debt. You may secure better loan terms if rates have dropped. Now, here are the cons for this strategy. There's higher monthly mortgage payment, less home equity, and increased total debt. Risk of foreclosure if unable to meet new payment obligations. Here are the best cash out refinance lenders. There's Rocket Mortgage, with streamlined online process, quick pre-qualification, and broad loan options. Navy Credit, Federal Credit Union again, has competitive rates for military members. VA cash out up to 100% LTV truest, adjustable rate estimates, long rate locks, multiple loan types, VA, FHA, jumbo, etc. Bank of America, it's a home value estimator, discount for clients, strong customer satisfaction. CD Mortgage is next, good for high value loans, interest rates / closing cost discounts. PennyMac is next, large VA lender, home value tools, competitive rates. We have AmeriHome, which is FHA specialist, cash out with credit scores as low as 580, right? And online calculators. Now, here are more tips to find, the best lender for this strategy. Compare rates and fees. Cash out refinance rates are generally higher than regular, refinances. So shop around for the best deal. Consider your loan type. Some lenders excel with VA or FHA loans, while others are better for conventional or jumbo loans. Check eligibility. So most lenders require at least 20% equity, a credit score of 620 plus, and a debt to income ratio below 50%. Look for discounts. So existing customers or military members may qualify for rate or fee reductions. Elevate or evaluate, customer service. There's fast closing times and digital tools that can streamline the process. The average APR for a 30-year fixed cash out refinance is around 6.9% as of this month, June 2025, but your rate will depend on your credit, equity, and loan details. So let's get into the next strategy, right? Which is leveraging your home equity. That can be a powerful way to generate enhanced monthly cash flow. Now, here's how you can do that with that HELOAN, which is basically the HELOC's cousin. But there's HELOC, there's HELOAN, HELOC, HELOAN. But let's get into that. And that's basically home equity line of credit, but HELOAN, home equity loan of credit, right? Now, a home equity loan provides a lump sum with fixed interest rate and predictable monthly payments, making it ideal for those who want stability and certainty in their cash flow planning. You can use the funds to pay off higher interest debts like credit cards, basically invest in income producing assets or fund home improvements that could increase rental income or property value. The fixed repayment schedule allows for easy budgeting, and the loan does not affect existing mortgage rates. Right now, let's get into, so a HELOAN operates as a revolving credit line, allowing you to borrow only what you need when you need it and pay the interest only on the amount drawn from the initial draw period, which is around 5 to 10 years. So this flexibility makes this strategy a strong tool for managing variable or unexpected expenses, like, those homes, right? This commercial real estate, right? covering short-term cash flow gaps or investing in opportunities that generate monthly income. During the draw period, your minimum payment is often interest only, which keeps monthly payments lower and preserves cash flow. After the draw period, any remaining balance is converted to a term loan with principal and interest payments, so it's crucial to plan for this transition. Now, in regards to investment and wealth building approaches, you can use the HELOAN funds to invest in assets that generate monthly cash flow, commercial real estate, commercial property, so like dividend, paying stocks as well and all those kinds of stuff. But we interested in that commercial property, right? The goal is for the investment's cash flow to exceed the HELOAN's interest payments, allowing you to pay down principal and potentially free up the line for additional investments, which is additional commercial real estate. For example, using a HELOAN to buy a flowing rental property can generate rental income that covers the HELOAN payments and provides surplus cash flow. Always ensure that your investments can reliably cover the interest and eventual principal payments to avoid financial strain. Now, it's also kind of like a cash out refinance alternative, right? A cash out refinance replaces your existing mortgage with a larger one, giving you a lump sum of cash while possibly securing a lower interest rate if market conditions are favorable. So this can be a good option if you want to restructure your debt and lock in fixed payments, but it does reset your mortgage and may, involve higher closing costs. Here are some key considerations for the HELOAN strategy. There are interest rates, right? So HELOANs typically have fixed rates, right? Sometimes with an initial fixed period. In regards to flexibility and predictability, HELOANs offer predictability for fixed one-time needs, okay? Now, cash flow management, the HELOAN can improve monthly cash flow if used to pay off higher interest debt or invest wisely, but careful planning is essential to ensure new payments are manageable. So borrowing, this is a risk to consider. Borrowing against your home increases your risk if you cannot make payments, potentially leading to foreclosure. So only use, home equity for investments or expenses that are likely to generate returns above the borrowing costs. Now, here are the best lenders for HELOANs. You have Citizens Bank, no application or closing fees. There's a $50 annual fee, which is waived after the first year. There's fast digital application process and relatively low advertised rates. Next, we have Alliant Credit Union, which is available in about half of the United States, offers interest-only draw periods and flexible repayment. Now let's get into the next strategy, which is selling your property to unlock home equity and generate monthly cash flow. Is basically, again, it's a common strategy, but here's how to do that when it comes to basically, kind of selling your home. So when you sell your home or investment property, you immediately convert your equity into cash. This lump sum can be, then be redeployed into income producing assets such as rental properties, dividend paying stocks, or other investments designed to provide steady monthly cash flow. One popular method is to use the proceeds to purchase multifamily or commercial real estate that generates rental income. As an example, selling a primary residence or rental with $400,000 in equity could allow you to buy a 12-unit apartment building, which, after accounting for vacancies and expenses, can provide substantial monthly cash flow. Now, here are the steps to implement this sell strategy. Number one, sell your property. List and sell your home or rental property to access the equity. Number two is calculate the net proceeds. So after paying off any remaining mortgage, closing costs, and taxes, determine the net cash available. Identify income producing investments, like research and select investments that align with your cash flow goals, such as, again, commercial real estate, right? Okay. Reinvest for cash flow. So use your proceeds as a down payment or full purchase for properties, commercial real estate, or assets that will provide monthly income. For example, investing in a multifamily property can yield rental income each month minus operating expenses and reserves, Monitor and adjust is the next step. So track your new investments to ensure they meet your cash flow targets and adjust your portfolio as needed. Now, here are some key considerations for this strategy. You have tax implications, so selling a property may trigger capital gains taxes. However, using a 1031 exchange can defer taxes if you reinvest in another like-kind property. There's cash flow analysis, so carefully analyze the projected income and expenses of your new investment to ensure it will deliver the desired monthly cash flow. There's, market conditions. You have to watch for that. The success of this strategy depends on local real estate markets, rental demand, and interest rates, which affect both sale proceeds and future cash flow potential. There's risk management, so diversify your investments and maintain adequate reserves that can help mitigate risks such as vacancies or unexpected expenses. Now, those were the 4 strategies. Now let's get into key considerations that you have to take into account before getting into commercial real estate. So number 1 is financial preparedness, right? Assess your financial situation to ensure, you have the necessary capital and a clear understanding of your investment goals. Consider how, much you are willing to invest, your financing options, expected returns, and whether you'll involve the lenders. So organizing your finances and planning, a realistic budget or crucial, basically they're crucial steps before making any commitments. Number 2 is location and market analysis. So the location of a commercial property is a primary driver of its value and potential success. So evaluate the local market, demand, supply trends, and future development plans. Look for areas with strong economic prospects, good infrastructure, and amenities relevant to your property type, whether it's foot traffic for retail, transport links for industrial. You want to do your due diligence. So conduct, thorough due diligence to uncover any potential risks or hidden issues. This includes physical inspection, structural integrity, mechanical systems, environmental hazards, are under that umbrella. Financial review, like the income/expense statements, rent rolls, cash flow projections, legal and regulatory compliance, that's title research, zoning, leases, permits, tenant analysis, like financial stability, lease terms, etc. The insurance needs and costs, so always use professionals such as inspectors, attorneys, and accountants to validate, basically information and identify, red flags, because they're going to be. There's property specific factors like evaluate the property's features and amenities based on its intended use. For offices, consider parking, natural light, and workspace layout. For industrial, look at loading access and proximity to transport. For retail, assess visibility and customer access. Then let's look at the return on investment, right? So carefully analyze the potential ROI by considering purchase costs, expected rental income, appreciation rates, and ongoing expenses. Use standard valuation methods such as cost approach, market approach, income capitalization, and gross rent multiplier to estimate the value. There's the cost of ownership and upkeep. So factor in all ongoing costs, including maintenance, utilities, taxes, insurance, and potential capital improvements. There's unexpected expenses that can significantly impact profitability, so budgeting for these is essential. There's legal and regulatory environment, so understand zoning laws, land use restrictions, and compliance requirements for your property. Ensure all documentation is in order and that the property meets local codes and standards. Look for market trends and tenant quality. So consider broader trends such as remote workers, impact on office demand, and shifts in retail or industrial needs. The quality and stability of existing or potential tenants can greatly affect the property's long-term performance. There's professional guidance, so seek advice from experienced investors, real estate attorneys, and accountants. Mentorship and professional support can help you avoid common pitfalls and make informed decisions. And always have an exit strategy if, things don't go right. That's what I have for you today. Hit that subscribe button and the like button. I appreciate you. See you in the next video.